Stablecoin risk. What's actually safe to hold? There's quite a few stablecoins out there. We are not just limited to Tether anymore. And in this video, we're going to talk about the main players, about the 8 largest stablecoins. How do they keep their peg? What could be a potential scenario where the peg might break? And how can you protect yourself from all of this? So let's start with the largest. Let's start with Tether, currently at market rank number 3. So the market cap here is at 78 billion. Tether has been around for quite a while, and one might question if Tether actually should be the largest of the stablecoins, because there is quite a bit of questioning around this. Tether in its mechanism is a stablecoin that's backed by real assets in the real world. So it started out as a cryptocurrency that was simply backed by dollars, but after a while, when there was quite a bit of FUD around the stablecoin, the issuer, it did confess that it's not just US dollars, but it's also commercial debt that's backing Tether. Now, there's even been lawsuits around this, so I'm not going to go too much into how much this fear is justified or not, but simply be aware Tether should probably not be your only stablecoin in your portfolio. At least diversify away from this. There is a bit of a protection in large numbers, right? One might argue Tether is potentially now too big to fail. If Tether really unpacks at some point in the future, we will have a major collapse. Simply due to its sheer size, a lot of DeFi protocols, they rely on Tether working. Now, the second largest stablecoin is USDC, which is issued by Circle and Coinbase. And it's not that much smaller than Tether nowadays. It has grown quite a lot. It hasn't been around for as long, but maybe at some point in time, a flippening here can happen in terms of market cap. The peg is very stable. The market cap continues to grow very, very quickly. And the backing here is not questionable at all. So this is properly audited. Coinbase is listed on the Nasdaq. And so the idea behind USDC and USDT is pretty much the same. If you've got the choice to rather hold USDC or USDT, I would always go with USDC. Now, still, this is not completely riskless, because you are somewhat exposed to the regulatory environment of the US. If the US in the end decides to outlaw USDC, which I don't think is very likely, but if that ever happens, then who knows if this peg can still stay intact. My personal impression is that the US government, or the SEC for that matter, their intention is to simply protect investors and to potentially help US dollar adoption abroad. And since USDC is directly backed by US dollars, with the adoption of USDC, you are helping the spread of the traditional US dollar. So I'd be very surprised to see USDC being outlawed at any point in time. This seems to be very solid. And so when you do yield farming, for example, and you have exposure to nothing but USDC, then I do think you're pretty much on the safe side. If you can only choose one stablecoin, then USDC is your best bet. Now, that being said, especially with stablecoins, there's not a lot of cost in diversification, right? When you diversify across volatile assets, you might always compromise returns. There's a bit of a return consideration with yield farming for stablecoins as well, but still the prices, they should be pegged to the US dollar. So it's really worth it to diversify, to have more than just one stablecoin. And so even though USDC is the best, you definitely want to own other stablecoins as well. Sometimes you are even required to hold several stablecoins, right? So for example, when you deposit in a liquidity pool, FRAX is one of the stablecoins we're going to discuss as well. If you deposit in a liquidity pool, you're betting on the peg of both of those stablecoins to stay intact. And so one side of that liquidity pool might be USDC, as seen over here. The other side might be something comparatively more risky. But if you're okay to take on the risk of that other stablecoin, you can get an APY of 11% easily. And these are comparatively safe bets. Now, regarding the stablecoin Cardano, the peg is sometimes breaking, so you might not necessarily get into that stablecoin. In case you're not that familiar with crypto, that was a joke, right? Cardano is not a stablecoin, but it tends to move sideways for quite a while. So that's somewhat of a joke within the Cardano community. Now the next stablecoin is already BUSD. And obviously the risk of that peg is very closely tied to Binance. If Binance at any point in time in the future gets liquidity issues, then this peg here might be in question as well. But when you work with the Binance Smart Chain, a lot of liquidity pools, a lot of swapping happens across BUSD. So if you want to avoid excessive swapping fees by going several routes, then you need to have BUSD as your stablecoin. So I'd keep BUSD not necessarily for multiple years in the portfolio. I'd simply hold it for your active trading part. If you're operating on the Binance Smart Chain and maybe trade altcoins and you want to go risk on, risk off, simply use BUSD temporarily, but don't hold that stablecoin over the next 10 years. Next, we come to something that pays out a lot of return, and that's the UST stablecoin. You can get 20%, roughly a bit less than that, on UST. That's with the Anchor protocol, so 19.5% per annum. There are some questions around the sustainability of that APY though, because there are currency reserves that are depleting, so the payouts here are larger, at least in the last weeks, than the earnings of the protocol. So at some point in time, this might decline. But overall, the Luna ecosystem and UST is managed very well. So I don't see this going to unpack anytime soon. Note though, this is not on an EVM compatible blockchain. So you can't just use your MetaMask. You have to use a different wallet, Terra Station, and then you also have to bridge your money over potentially, right? When you currently have your stablecoins, say on Ethereum, and you want to bring it to the Terra ecosystem, you have to use a bridging protocol, which also has potentially some kind of risk. Bridges, they do sometimes get hacked. So far what we can get from all of this is every stablecoin has their risks, and the kinds of risks, they are somewhat different, right? Sometimes you've got regulatory risks, sometimes you've got risks around adoption, around cryptocurrency volatility, around the solvency of a particular company. So the best really is, if you're planning to deploy a significant amount of money, to spread out your risk, to have multiple stablecoins. On market rank number 19 with a market cap of 10 billion, we've got DAI. And DAI is an algorithmically backed stablecoin. Now, what does that mean? In the case of DAI, we've got MakerDAO, so people can borrow and lend cryptocurrencies, and with that deposited cryptocurrency, one can withdraw the stablecoin DAI. And when the backing or the collateral falls below a certain value, we get a liquidation event, and so there's always enough collateral to back one DAI stablecoin. We can also see the adoption here growing over time. DAI has been around for a long time, and it has proven itself over the last crypto winter. So if you're looking for an algorithmically backed stablecoin, DAI is probably your safest bet. Most of the newer stablecoins, they are algorithmically based, but sometimes these cryptocurrencies, they can lose their peg. So you want to bet on something that has established itself over quite some time. DAI is definitely one of those well-established stables. There are three more stablecoins that are relatively popular. That's Magic Internet Money, FRAX, and MIMATIC or MI. They work somewhat similar. So Magic Internet Money is again an algorithmically backed stablecoin. So you deposit your collateral on the Abracadabra platform, and then with that collateral you can get stablecoins issued by the protocol. And the reason why people do this is because you can get leverage on this. So you can deposit $10 and in the end get more Magic Internet Money out of this, and you simply get liquidated quicker, right? With less of a price movement of the collateral. So there's a strategy around this called the degen box that always deposits on a protocol such as Aave, a lending protocol, and loops through borrowing, lending, borrowing, lending. You get a lot of leverage, and you do this via Magic Internet Money. Now, there was a temporary unpack over here. This happened during the Time Wonderland hack. So the person behind Magic Internet Money, Daniele Sesta, he had quite a rough time recently because there was a criminal involved in Time Wonderland, which was an Olympus DAO fork. So you don't need to understand all of this, but what you need to know is among the algorithmically backed stablecoins, this is quite widely used, but it does have quite some risk as well. So I would not feel comfortable holding this over 10 years. There have been hacks around projects from Daniele as well, Popsicle Finance. So use this for active trading. Use this if you're interested in leverage, but don't just keep this in your wallet in large quantities for multiple years. It does make sense to rather be too cautious than too risk on, especially when it comes to stablecoins, because there's very little to be gained when being involved in something that doesn't have much upside potential, right? Next, we've got Frags. If you're interested around the details of Frags, there's the website cryptorisks.substack.com, and in here we've got a dedicated article on Frags. So Frags is partially algorithmically, partially fixed asset backed, so it's a relatively new approach, but it seems to be executed comparatively well. If we look at the adoption over time, it is increasing. That's because quite often you also get pretty good returns on the liquidity pool. And look at the pack, there's not too much fluctuation. Let's also quickly look at MIMATIC. It's not that widely used, right? It's mainly used on Polygon. Again, an algorithmically backed stablecoin. You deposit your Polygon MATIC tokens. You get the My Stablecoin out of this. That's the pack. It's not perfect, right? Sometimes we are 1% below. Sometimes we are slightly above. Simply another option, and probably only worth considering if you're active within the Polygon Layer 2 blockchain. If you found this video useful, consider subscribing, because I publish videos regularly. Not just educational videos such as this, but also videos around altcoins or around the general crypto market. Where might Bitcoin go? Where might Ethereum go? I publish roughly one video a day. If you've got any questions or any additional info you'd like to add, feel free to comment this down below as well. Any kind of engagement will help the algorithm, and that will help this channel grow. There's two more things. A public Telegram channel that's down below here. And you can also check out the premium membership. There's of course exclusive content and a private chat where you can ask me any questions. See you next time. Bye bye.